let's revise Ind AS 38, intangible assets, with the help of our chart book quickly. One, sir, if you want to call it as an intangible asset, like tangible asset, PPA had some definition, intangible asset also has a definition. If you want to call something as an intangible asset, one, it has to be identifiable, non-monetary asset without physical substance. Identifiable, non-monetary asset without physical substance. So what is this identifiable? If you want to call something as identifiable, no, you should be able to separate it and sell it. If you want to call something as identifiable, you should be able to separate it and sell it. Sir, I have a software. Okay, my company has a software. Can I sell software alone? Yes. Do I need to sell my company to sell the software? No. I can sell software alone. If I have patent, can I sell patent alone? Yes, I can sell it alone. I have a goodwill of 10 lakh. Can I sell it alone? No. So that means goodwill fails identifiability criteria because it cannot be separable. It cannot be separately sold. You cannot separate it or sell it. Okay. If you want to call it as intangible asset, it should be able to. It should meet the identifiability wala criteria. Goodwill will fail this criteria. That means goodwill you will not account it, sir. So the goodwill is accounted as per Ind AS 103 business combination. Whatever is the provision of Ind AS 38, no, you will apply for all other intangible assets except goodwill. For goodwill, you will have to apply Ind AS 103 ka provision. Okay. So you will not apply all this provision. So that is your identifiability value criteria. Second is non-monetary asset. Non-monetary asset means we already studied. Monetary means whose value is fixed. Non-monetary means value fluctuate. Obviously, if you purchased a paid software worth 10 lakh, after 6 months, its value will be 10 lakh only? No, its value could be more or its value could be less, meaning value will fluctuate. So second criteria of intangible asset is it should be a non-monetary asset. That's self-explanatory. And asset means what? The basic definition. If you want to call something as your asset, no, it should be within your control. It should be within entity's control. Okay, meaning entity should be able to use it the way they want it and get substantially all the benefits. Okay. So that means few aspects will not fulfill this asset wala criteria, like training cost to employee. If you're giving any training cost to employees and all, no, you could say there are huge benefits, so I'll capitalize it. No, training cost to employees, market share, customer loyalty and all, you cannot capitalize this intangible asset because there is no control. So all this, if you see in your case study, and if they say anywhere it is capitalized as intangible asset, that is wrong. You're violating Ind AS 38. So if you're incurring any cost towards this, it will be straight away expensed off, transferred off to P&L account. Okay. All right. Another one is without physical substance. Without physical substance means without physical substance, literally don't interpret, because when you buy a software, sometimes software will be delivered to you in pen drive or CD. That means it is delivered through a physical, it does have a physical substance. Yes or no? So what standard means by without physical substance is the value of physical substance is very negligible or immaterial. All right. So you're paying, let's say 10 lakh rupees for software, but the pen drive only costs 100 rupees. So the majority of the amount that you're paying is towards the software, and software is, it doesn't have any physical substance. Okay. That one. So even if it has physical substance, the value of the physical substance is immaterial or insignificant. Okay, like that. So what if physical substance ka value is material? Like you purchased a computer. When you purchase a laptop or a desktop, laptop also will have some inbuilt software like Microsoft Office, etc., etc. So in that case, what to do, sir? Microsoft Office is a software which is an intangible asset. Laptop is a tangible item which is PP. In that case, what to do? If a component has both tangible as well as intangible asset, you need to check which is the dominant element. A person who's buying laptop, no, his main intention is not to buy the software. His main intention is to use the laptop. So the dominant element in that case will be tangible item, which will be laptop. So the entire component, if you have paid 1,30,000 to buy a laptop, entire 1,30,000 will be classified as PP itself, and Ind AS 16 applies. Okay, like you purchased the software came in a pen drive. Right? So the value of pen drive is very insignificant. So dominant element here is the software one. So the entire amount, whatever you paid, will be classified as an intangible asset, and Ind AS 38 will apply. Like that. You need to check if it has both tangible and intangible asset. You need to check which is the dominant element and accordingly figure out whether it is tangible or intangible. Okay. So this is your definition. All right. Recognition criteria is same as PP. If you want to show intangible asset in balance sheet, there must be some future economic benefits, and cost of the asset also should be measured reliably. Okay. Then initial measurement, like PP, even intangible assets are initially measured at cost. So cost for this purpose means what? One is the purchase cost. If you have any trade discounts and non-refundable taxes, add it. If you have any directly attributable cost, your directly attributable cost could be your customization charges, registration charges, testing charges, etc., etc. All that can be added. Okay, fair enough. And amortization of patent license. If you're using one intangible asset to produce another intangible asset, like a software 1 is being used to produce software 2. Then that software 1 ka amortization will not be transferred to SPL. It will be added to the cost, or it will be capitalized to the software 2 ka cost, like that. Okay, so if one intangible asset, if it is used to produce another intangible asset, then software 1K in my example, amortization charges will not go to SPL, rather it will get capitalized. That's what is this point all about. Okay, these are some inclusions. Next will be some exclusions. Exclusion is same. If you have any refundable tax, exclude, trade discount, exclude. Few things we already called. Same. General overheads, administrative, selling and distribution overheads, relocation cost, reorganization cost, user training cost, any sort of promotion expenditure, opening ceremony cost, advertisement, marketing, blah, 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 customer royalty, all that will be excluded. Meaning all this cost will be straight away transferred off to SPL. They will not get capitalized. Okay. Then subsequent cost. Generally, subsequent cost in intangible asset, we say will not fulfill the recognition criteria, hence we transferred off to SPL, but that is debatable also. Case by case basis, you need to assess. Okay. In terms of the other things, consideration, cash consideration, deferred consideration, exchange terms, all these are same as PP. Whatever you learned in India 16, same will hold good here also. What about government grant? Let's say government gave you software at free of cost. Software is worth 1 crore. That 1 crore software government gave you at free of cost. Then two options is available. Let's say the worth of the software is 1 crore. So fair value of that is 1 crore. Okay. But how much did you pay? Nothing. So you paid 0. So what Ind AS 38 says is, okay, you have an option to record that intangible asset either at fair value or nominal value. Okay, both. You have received a government grant here, no? So both intangible asset and deferred government grant, both can be recorded at fair value or both can be recorded at nominal value. In fact, this option is given in Ind AS 20. Same thing, Ind AS 38 is also same. Okay, so if you have received any grant, you have an option. Meaning here the fair software value is 1 crore, no? So software also you can recognize it at 1 crore and government grant also you can recognize it at 1 crore. That is option number 1 because 1 crore being the fair value. All right. Or nominal value. Nominal value could be 10, 100, whatever, or 1 rupee also is okay. Just record it for the sake of it. Okay. Both grant as well as asset could be recorded at nominal value itself. Company has a choice. They can go either for fair value or nominal value. All right. Next one is internally generated assets. If you have any internally generated intangible assets, they are broadly classified into goodwill and others. Internally generated intangible assets are broadly classified into goodwill and others. Goodwill means, first of all, if you have any internal generated goodwill, it cannot be shown in the books. Internally generated goodwill means, you remember in your bachpan golden days, you used to calculate goodwill under average profit method, super profits method, capitalization method, blah, 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 blah. All that we call it as internally generated goodwill. It cannot be recognized. Okay. That means which goodwill can be shown, sir? If you have purchased, if you have done any business combination. Alright, there if you're getting any goodwill, that is not self-generated goodwill, that is your purchased goodwill. Such purchased goodwill you can be shown in your books. So internally generated goodwill cannot be shown. Okay. Now the others. Other internally generated assets are further categorized into research phase expenditure and development phase expenditure. Okay. Research, first maybe I'll quickly run through and then maybe take up a small example. If you are incurring any research phase expenditure, and it says straight away transfer research phase expenditure to P&L account. Why? Because standard feels at research phase, entity cannot demonstrate two things. One, they cannot demonstrate the very existence of intangible asset. And two, how much future economic benefits you will get from that intangible asset also. You cannot value with certainty or reasonable certainty. You don't have towards these. That's the reason research phase expenditure are not capitalized as intangible asset, but straight away they are transferred off to P&L account. To give you an example, when COVID hit, many companies were doing research as to find out the COVID vaccine. Do you think every company was successful? No. Few were, majority of them were not. Yes or no? So that means the research could be a success or it could be a failure. Hence, Ind AS 38 has taken a view that in whatever expenditure you are incurring in research phase, do not capitalize but straight away transfer off to P&L. Because at research phase, you cannot tell whether research is going to be successful. Only if research is successful, then you can file a patent on that COVID vaccine. Only then intangible asset will arise. Yes or no? But whether that is going to happen or not, we can't say with certainty. That's what standard says. At research phase, you cannot demonstrate whether intangible asset is there or not. You cannot tell. That's the reason. And two, how much benefit you will get from that intangible asset also, you cannot tell with certainty at research phase. That's the reason. Okay. Another one is this. I normally say this in class. Research phase expenditure is like Tirupati Hundi. You put money into Hundi means gone. Again, you cannot take it back. Same like that only. Let's say in first year, there was a research phase expenditure of 10 lakh. I mean, this research phase expenditure of 10 lakh, what you would have done? Transferred it off to P&L account. So in first year research, you transferred off to P&L. Second year, let's say the research was successful. Okay. Then now the question is, whatever 10 lakh I had transferred to P&L in the first year, can I reverse it and recognize it as an intangible asset? Standard says no. Once you have transferred research phase expenditure to P&L, it is gone. In subsequent years, you cannot reverse the previous year's expenditure. Once gone, gone. All right. Next is the development phase expenditure. If the research is successful, then you will start developing. All right. Even development also may go on for some time. It may go on for 5 months, 10 months, 15 months, 20 months, 2 years, 3 years also. Especially COVID vaccine and all. You have to develop it for world population. So even development can go on for 2-3 years, right? So can development expenditure be capitalized? Yes, provided conditions are satisfied. That condition for class purpose, we used to call it as TRFRC. Yes, TRFRC. What is T? T for technical feasibility. Once I'll call out T for technical feasibility, I for intention to complete, A for ability to use, F for future economic benefits, R for technical, financial and other resources, C for cost measurement. If all these are satisfied, all of them, not one. If all of them are satisfied, then development phase expenditure you can capitalize. Even if one of them fails, development phase expenditure will not be capitalized but transferred to SPL. So what is this T for technical feasibility? Technical feasibility means check whether you have the necessary technical expertise to develop that particular product. That's what T is standing for. I is the intention to complete. Sir, even development phase expenditure, as I said, sometimes could go for 2-3 years. Maybe initially you had the Josh. Later, after 4-5 months, the Josh could fade off. So see whether you really have the intention to also to develop that product fully and then sell it. So intention to complete is important, which all these are management assessment. Okay. A for ability to use. Okay. You are developing it, but do you have the ability to use it or sell it? Because developing requires some skill set. Selling and using it also requires a different skill set. See if you have those skill set. Does the company have it? F for future economic benefits. How much future economic benefits you get, you should be able to estimate. R for the resources, whatever resources that you need necessary for developing, human resource, property, plant and equipment, etc. Whatever resource required, do you have it? First check. Last one is cost measurement. How much ever you have incurred toward development phase expenditure, that cost you should track it separately. So if you are able to satisfy all of this, then capitalize. Otherwise, do not capitalize. Okay. All right. Subsequently. So like same like PV model. Initially, you have to follow it at cost. Subsequently, at year end or subsequent year ends, you can either go for cost model or revaluation model. Cost model means simply take the carrying amount of the asset, go on reducing depreciation. For intangible asset, it is amortization, and if there is any impairment loss, reduce. That is your cost model. Revaluation model means to show the asset at fair value. All the drama is of revaluation is same thing, nothing. Okay. But if any intangible asset has no active market, then revaluation model for such asset is not allowed. Active market means large number of buyers and sellers. To do revaluation model, people, you need fair value. Fair value, you will get it from active market price. So if any intangible asset is so peculiar or it is so new that if it doesn't have active market, then standard recommends that don't go for revaluation model only for such intangible asset, which does not have active market. So if it doesn't have active market, go only for cost model, don't go for revaluation model is one exception that they brought it. Okay, then it is a useful life. These are factors that determines the useful life, and we have already discussed useful life is from management viewpoint, not the total life, it's from management viewpoint. Useful life can exceed contractual life. Useful life can't exceed contractual life, but it can be shorter. What does it mean? So let's say there is a software. The software life is 5 years, but the software you did not buy, you received it from government. The software you received it from government. Okay, and government told you can use it only for 4 years. All right. I mean, let's say you're showing the software at fair value. That means you need to depreciate. Now you will depreciate over 5 years or 4 years. You will depreciate it only over 4 years. Though the software can last for 5 years, you can use it, or you have a right to use only for 4 years. So you will use it only for 4 years. That's what we mean by that. Useful life cannot exceed contractual life, but it can be shorter. Okay, that's the point. And useful life, if you have any renewable life, if useful life can be renewed, generally sometimes it happens. No, you get a license, you buy a license, and the license can be further renewed. You bought a license for 5 years, it can be renewed for 2 more years. When you initially bought it, the life was 5 years. You have option to renew it for 2 more years. That means that 2 more years ka renewal life should be add or not. Standard says you can add, provided if you feel all the conditions are going to be satisfied. If there is any condition attached towards renewal, management should have a reasonable assurance that they will fulfill those conditions. If any third party consent is required to be obtained, especially government approval, etc., quite may be possible in few cases. So if any third party consent like government is required to be obtained, company should have a reasonable assurance that they will receive this consent. And 3, cost of renewal is insignificant compared to the benefits. Let's say if you renew, you are expecting a benefit of 10 lakh rupees. Initially, when you bought a license, life was 5. You have an option to renew it for 2 more years. If you want to renew it, means obviously you'll renew it only if there is a benefits. Company feels if they renew it for 2 years, they will get extra benefit of 10 lakhs. But to renew it, let's say they have to pay a renewal cost of 2 lakhs. So benefit is 10 lakh, cost associated is only 2 lakh. That means organization will think about living out on renewal option, or they will go for renewal. They most probably will go for renewal. That's what they mean by that. Cost of renewal is not significant compared to benefits, meaning benefit is greater than the renewal cost is what they're trying to say. So what if it's other way around? If the cost of renewal is significant, still if you renew it, then better standard says you treat it as a separate intangible asset. Don't add the renewal cost to the old asset. Treat it as a separate intangible asset. Okay. All right. So what if you have intangible assets? Amortization concept of intangible asset is also same. If you want to amortize intangible asset, one DA should be positive, useful life should be limited. Sir, can any intangible asset have unlimited useful life or infinite useful life? Yes. That only standard uses the term as intangible asset with indefinite useful life. Indefinite useful life is infinite or unlimited useful life. Sir, what such assets, sir? Sir, if you just check, I think I gave the same examples and we have case study also in our books relating to this. One is landing rights. Let's say companies operating in airline industry, let's say Indigo Airlines, right? Obviously, they park their aircrafts in the airports, Bangalore airport, Mumbai airport, Delhi airport, like this, they'll park, right? Can any Tom, Dick and Harry go and park their vehicle in the airport? No. If you want to use airport space, you need to have something called landing rights. If you want to use that space, you need to have permission from the government. That only we call it as landing rights. Let's say Indigo Airlines has got a landing rights for 10 years from the government. Okay. After 10 years, they'll go on renewing it for 5 years, like this. Okay. There'll be some conditions, you'll go on renewing. Now you practically think the contract may say the life is 10 years. After 10 years, do you think this landing rights will be cancelled? If landing rights is cancelled, means Indigo company should be shut down. That means what do you think will happen after 10 years? Again, you will renew it. Again, after 5 years, again, you will go on renewing. Like this, you will go on renewing, because the moment you stop renewing, your whole company will shut down. That means for the name's sake, the contract has a life of 10 years. But in reality, this asset ka useful life is infinite. So that's what we mean by intangible asset with infinite useful life. If at all you have such intangible asset, so to amortize, you need a life. If life itself is unlimited, means you cannot amortize such intangible asset, but you only do for impairment check. Amortization will not come, but you only have to do impairment check, and this impairment check has to be done every year. Annual impairment check is necessary for such intangible assets. Okay. Amortization, as I told you, it is the same thing. Here also, revenue method of charging amortization of intangible asset is not appropriate. However, if you can, rarity, if at all you can correlate, if you feel pattern of economic benefits and revenue are highly correlated, because you know amortization method is based on pattern of economic benefits. If pattern of economic benefits and revenue, they are closely related, then the revenue method can be adopted. Like when, sir, let's say you have a software, taking the same example, you did not purchase it, but government gave you. The government told you, use the software till you achieve 1 crore revenue. Till you achieve 1 crore revenue by using software, you use that software. After you achieve 1 crore revenue, you have to stop using that software. That means here, life of the intangible asset is exclusively based on revenue. So it means here, benefits and revenue are highly correlated. So in this case, in the ratio of revenue, if you want to charge amortization, that is appropriate. In all other cases, it is not acceptable. Only in this exceptional case, it is permitted. Okay. Next is residual value. So generally we assume intangible asset. If there is no information, generally we assume residual value of intangible asset to be 0. Right? However, you can adopt residual value. You can take residual value provided if there is any third party guarantee. Like let's say one third party has come to us and told, I'm using one software. That third party told, after 3 years, I'll buy your software for 1 lakh rupees. I'm currently using that software. One party or one entity has given me a guarantee that after 3 years, he'll buy the software from me for 1 lakh rupees. That means this 1 lakh only can be adopted as residual value because third party guarantee is there. If this is not there, check if there is active market for that intangible asset. And can you find out residual value from that active market? If the answer is yes, there is an active market, you can find out residual value from that active market, and that active market will be there till the end of asset ka useful life. Let's say I want to use the software, my software I want to use it for 5 years. If the company feels there is active market and active market will exist till 5 years, and using active market we can figure out what is residual value, then you can take residual value for intangible asset. If both are not satisfied, means we assume residual value for intangible assets to be 0. Okay. And as discussed for PP, any change in useful life, any change in residual value, any change in your depreciation method or amortization method is a change in accounting estimate, and accounting estimates are always applied prospectively, meaning from that day onwards. Not retrospectively means from day one, from the beginning. Prospectively means from that day onwards in future may you apply. Okay. Disposal also same. Any gain or loss will transfer it off to P&L account. Excuse me. Okay, let's go over some questions relating to intangible assets, people. Okay, this is about exchange. Exchange we have already seen, no? Yes. Okay, maybe we'll recap what is, if there is an exchange of intangible asset, meaning one non-monetary item has come in, another non-monetary item has gone out. So that only we call it as exchange. So thumb rule is, you have to use, for all exchange transaction, you have to use fair value. Fair value need not be used under two circumstances. One, both asset coming in and asset going out to fair value, you cannot find out. Two, transaction lacks commercial substance. And when can you say transaction lacks commercial substance? Asset-wise cash flow is also same, entity-wise cash flow is also same. Okay. So if you're not using fair value, then you will use carrying amount, meaning no gain or loss will be accounted. That's a provision. Let's apply it in this particular question. Sun Limited acquired software from ArP in exchange of telecom license. Maybe we'll write this first. Sun, and this is ArP. For Sun, what is coming in, what is going out? That we will write. In and out we will write. Okay. Let's look at this. Sun acquired software. So software is coming in in exchange of telecom license. So license is going out. For ArP, what it is, other way around. Because I think they're asking the journal entry both for Sun and ArP. For ArP, license is coming in, software is going out. First, maybe we'll do it off for Sun. Okay. The telecom license is carried in the books at 5 lakh rupees. So carrying amount is that. Software is carried at 10,000 in the books of ArP. That is the carrying amount. Advise the journal entry in 3 particular scenarios. First scenario, fair value of software is 520, fair value of telecommunication license is 5 lakh. So both assets. Obviously, first is one is a software, another one is a license. Do you think by using software and license you will get same cash flows or different cash flows? Obviously different. That means asset-wise cash flow itself is different. If asset-wise cash flows are different, then transaction has commercial substance. If transaction has commercial substance, obviously we have to use fair value. In the first scenario, both assets ka fair value is given. So which one to use? Whichever is more clearly evident. That's what standard says. For example purpose, what I told, use the fair value of the asset given up. Here Sun Limited gave up what? License. Do you know the fair value of license? Yes, the fair value of license is what? 5 lakh. So what is the journal entry they'll pass? They'll write software account debit. The software account they will debit and they will show the software at fair value. Whose fair value? Asset given up ka fair value. What is asset given up? License. License ka fair value is how much? 5 lakh. So software will be recorded at 5 lakh. All these numbers are in thousands. So this is basically 5 lakh. To what? What went out? Telecommunication license. So license you will credit. License you have to derecognize. Derecognition and all will happen at carrying amount. Because you have to cancel means whatever value you are showing and that value only you need to cancel. Yes. So what is the carrying amount of that license in their books? 5 lakhs. Okay. So that means you will credit license also to the extent of 5 lakh. This is 0 has come over here. So profit or loss on exchange is nil in the first case. Okay. Next, second case, fair value of software is not measurable. All right. So, telecom license is 4,90,000. So fair value of telecom license they're saying is 4,90,000. That is what is given up. Anyway, we use fair value as asset given up only. Here they're saying fair value is 490. I mean software will be debited to the extent of 490, but license you have to credit to the extent of 5 lakh because that is a book value. You're debiting 490, crediting 5 lakh. So there is a difference of 10. There's nothing but loss on exchange. It could be profit or loss. It doesn't matter. All this profit or loss will be transferred off to P&L or SPL account. All right. Second scenario. Third scenario. Neither fair value of software could be reliably measured. Both ka asset ka fair value if you cannot measure means then you use book value. What is the book value of license? 5 lakh. That means software also will be recorded at 5 lakh. Telecommunication license will be credited for 5 lakh. So in this particular case, you will not book any profit or loss. Whatever is the carrying amount of the asset given up. So asset acquired also will be recorded at same value. So no profit or loss will be accounted. This is for Sun. Next will be for ArP. For ArP, what came in? License came in, software went out. So that means first priority will always be fair value of the asset given up, which is software. Okay, in the first case, do you know the fair value of software? Yes, 5,20,000. What asset came in? License. So license will be recorded at 5,20,000, which is a fair value of the asset given up. Okay. Since software is gone out, what is the software carrying amount in ArP Limited ka books? Software ka carrying amount is 10,000. 5,20,000 debit, 10,000 credit. So 5,10,000 is basically profit on exchange, which will be transferred off to P&L account. That is the first case. Second case, fair value of software is not given. So that's what ArP gave up. They're saying fair value of the asset given up is not cannot be measured. If that is not there, we will use fair value of the asset acquired. Acquired is telecommunication license. Do you know that? 490. That means license will be recorded at 490. You have to derecognize software at 10. So profit on exchange will be 480. In last case, both asset ka fair value is not determinable. Means you will use carrying amount. What did Earth Limited give up? They gave up software, and software ka carrying amount is how much? 10,000. That means license also will be debited at 10,000. Software also will be credited at 10,000. No profit or loss will be accounted. This is your exchange transaction cover. Okay. All right. The next is question number 9. Let's quickly run through this. Excuse me. Expenditure on new production process is 20x1x2. In that year they've given 1st April to December, January to March. So this is for 9 months. How much expenditure is incurred? This is for 3 months. So they're developing one process. So internally generated assets that they're talking about. Okay, we know the concept already, right? If it is internally generated assets, first you have to categorize them as goodwill and others. Goodwill don't recognize. Others are further subcategorized into research phase and development phase. Research phase expenditure goes up to P&L. Development phase expenditure can be capitalized provided TIFRC is satisfied. So we'll see. Total is 3600. These two addition. Production process met intangible asset recognition criteria on 1st January. That means TIFRC is getting satisfied on 1st January. So any expenditure before January will not be capitalized but transferred to P&L because it becomes research phase expenditure. So before January is all this. So this 9 months expenditure of 2,700, you'll transfer it off to P&L account. Okay, that is the first thing. All right. What about this 900? This 900 you will capitalize. Okay, is it available? No, you're still developing. So you can't show it as intangible asset in balance sheet. No, there is a separate category called intangible asset under development. Not when you say just intangible asset, that intangible asset is already available for use. This is not yet available for use. It is still under development because it's a development phase expenditure. So there is a separate category called intangible assets under development. You will show there. How much did you incur? 900. What about the recoverable amount of this? 1000. We know this. So carrying amount of that intangible asset under development is 900. Recoverable amount is 1000. You know, you have studied impairment loss ka standard. If carrying amount is greater than recoverable amount, you will get impairment loss. Here, is there any impairment loss? No, there is no impairment loss over here. Okay. That means the carrying amount of intangible asset will be shown at 900 for that year. Okay. Next, what they told. Expenditure for development in the next year. So as I told, development phase expenditure also can go on for many years. So next year again you incurred 6,000. Already you had capitalized 900. This is for year 2. Again you incurred 6,000. That means the carrying amount will become 6,900. Okay. The asset was bought into use at the 31st March 20x3. So the end of second year asset is available for use. Now it is no more a development phase expenditure. From intangible asset under development, you have to show it as intangible asset. And is expected to be useful for 6 years. Okay. Alright. Now what will be? They have not given any recoverable amount. So second year ka carrying amount of intangible asset will be 6,900. Alright. Next, what are they saying? What is the carrying amount of intangible asset as on 31st March 20x2, x3? We have already done that. Okay. At 31st March 20x4, that is your year 3, amount estimated to be recoverable amount from the process is 5,000. Okay. 5,000 is what they're saying. All right. So in year 3, what is the carrying amount of the asset? Carrying amount of the asset is here only they've written. Carrying amount of the asset is 6,900. 6,900? No. At the end of year 2, intangible asset was available for use. Correct? No. At the end of, that's what they said in the problem. Here, where is it? Asset was bought into use on 31st March 20x3. We are not talking about 31st March 20x3 here. We are talking about 31st March 20x4. That means intangible asset is available for use on this date. Now we are talking about 31st March 20x4. That means you have used that intangible asset for 1 year. So carrying amount will not be 6,900. You have to depreciate, amortize this. What is the life they told? They told intangible asset ka life is 6 years. So 6,900 divided by 6, if you do, amortization is 1150. So if you do it, carrying amount will be at the end of year 3, carrying amount will be 5750. And they have told recoverable amount on the same day is 5,000 rupees here. They told carrying amount is 5750, recoverable amount is only 5,000. So that means you will get an impairment loss of 750 because carrying amount is greater than recoverable amount. We have already studied this. If carrying amount is greater than recoverable amount, there will be an impairment loss. That's what they have charged over here. Okay. And after you charge impairment loss, carrying amount will reduce and it will again become 5,000 rupees. That is nothing but your recoverable amount. After impairment loss, carrying amount and recoverable amount will become same. So simple question, but has been asked a few times. Okay. So this could be one of the important questions. Not saying this will come, I'm just saying has been asked a few times. All right. This is one. Then this is okay. You can go through this question. It's a simple question. Little drama. It was an RTP May 2020 question. Okay. All right. It's simple. It's about impairment loss only, or simply if I have to tell you in one line, what is it? So that you're working on some process. Okay. So you started working from the beginning of the year. Regulatory testing was obtained only from 1st June. That means it met TIFRC satisfied only from 1st June. 20x5. Okay, current year starts on 1st April 20x5, but you've obtained approval only from 30th June 20x5. That means indirectly what? April, May, June. 3 months ka expenditure TIFRC was not satisfied. That means that April, May, in fact, 1st June, sorry, not 30th June, my bad. They've given the date as 1st June. 1st June 20x5. That means 2 months. For the first 2 months, TIFRC condition was not satisfied. Approval received only from 1st June. That means 2 months ka expenditure, whatever you have incurred, has to be transferred off to SPA. And the total expenditure you have incurred is 18 lakh. So 18 lakh into 2 by 12 you do. That is 1/6. So basically 3 lakh of this 18 lakh expenditure you will not capitalize but transfer to SPA. 15 lakh worth this thing you will capitalize. It's a development phase expenditure which can be capitalized. Okay, that's all is the drama here. All right. Then obviously we already know this, right? There could be an impairment check also. An offer for 7,80,000 for new has been received. So how do you get recoverable amount? We'll study impairment loss in a bit. Recoverable amount is higher of two things. One is fair value less cost to sell, or value in use. By using it, how much you will get, or by selling it, how much you're going to get. Okay, if you want to sell this, you will get 7,80,000. So this is your fair value less cost to sell. By using company feels they'll get 12 lakhs in perpetuity. Company is overestimating. They feel every year will get 12 lakh. But there is one director of research, Neha, who is a qualified electronic engineer. Okay, so there's an engineering process. So she's the director. She feels, the present value of future cash flow will only be 9,60,000. So it will not be 12 lakh in perpetuity. It will only be 960. Since she is better qualified at this, so value in use will be adopted as 9,60,000. So if you sell, you're going to get 780. By using it, you're going to get 960. Higher of the two will be your recoverable amount. So basically, recoverable amount in this case will be 9,60,000. Carrying amount is 15 lakh. Recoverable amount is only 960. That means indirectly you'll get impairment loss of how much? 5 lakh. 40,000. That's all is the drama about this question. Full blade they have put. Okay. The drama is just around how much you'll capitalize as intangible asset and is there any impairment loss. That's all is given in this particular problem. 5,40,000 is impairment loss. Okay. In fact, I've called out here also. Okay, sir. We don't have so much time, so I'm just giving you a quick overview of all these questions. Okay. Apologies for that. But yeah, I hope you can understand. All right. So this is another, I think, MTP question or something. Super Sounds Limited had the following transaction in the current year. Super Sounds purchased net assets of Music Limited. So there's a business combination. They purchased it for 13,20,000. So PC is 13,20,000. Okay, semester. Okay, no problem. Here only we'll solve. PC is 13,20,000. Okay. They just said purchased. That means they've not given the percentage, means it is always 100% acquisition. So that means is there any NCI here? No, NCI is 0. So what is the fair value of net assets? Net asset ka value is only 10 lakh. We know how to calculate goodwill. No? We have done business combination problems. PC plus NCI minus net assets. So goodwill here is 3,20,000. On the date of control, you have a goodwill of 3,20,000. Sound Limited is the view of that the popularity of music product, life of the goodwill is 10 years. So they are saying life of the goodwill is 10 years and we'll amortize goodwill by 10 years. Is that acceptable? No. Goodwill is 3,20,000. Goodwill, we already studied. Goodwill that you get as per, there's no Ind AS 103, they are not amortized, but they are only tested for impairment. So here what you have to say, goodwill ka value is 3,20,000. They are not amortized, but annually you need to just do an impairment check. That's all the way. No amortization on this. That's the first. All right. Next will be what's it? Like this, they've given 2-3 assets. Super Sounds purchased a franchisee, okay, for 80 lakh rupees at an annual fees of 2% of musical shows revenue. So they paid 80 lakh and whatever revenue they get every year, 2% they will pay. This is more like upkeep expenditure. This 2% will be transferred off to SPA. Okay, how much ever revenue you generate, 2% of that you will give. Musical shows revenue were 10 lakh in first year. Next 2 years, may it is this. Okay, so first of all, so this is a franchisee is an intangible asset. Can you amortize this? Yes, because its life is only few years, which is 5 years they're saying. Should you amortize? Yes. Okay, residual value is not given, so we'll take it as 0. So DA is positive, useful life is 5 years, that is limited. So will you amortize? Yes. Will you amortize based on revenue ka ratio? No. Sir, if the pattern of economic benefits and revenue, only if they're correlated, then only you can amortize based on revenue. Here, are they correlated? No. Here, normal amortization you need to do. So 80 lakh divided by 5. Residual value is 0. That means 16 lakh you will amortize every year. So 80 lakh you purchase, 16 lakh is amortization. After amortization, the closing balance of franchisee will become 64 lakh. That's what they've called. Okay, and this amortization expenditure will be transferred off to P&L account. Next is what? on 4th July, Super Sounds, same company, they granted a copyright that had been applied by a music company. In fact, one more thing, first year revenue is 10 lakh, no? 10 lakh at 20% is how much? 20,000. That will be transferred off to expenditure. Here they've also given a schedule. You just need to prepare balance sheet and P&L extract here. Okay. In other expense, if you just check the 20,000 fees, 10 lakh revenue into 2% of the franchisee fees will be booked as another expense. That is 20,000. Okay. All right. Next, what? Sound Limited was granted a copyright that had applied by music during financial year, current year. Super Sound has granted a copyright that it had been applied by Music Limited. Okay, they got copyright. During the current year, Super Sound Limited incurred 2,50,000 in legal cost to register the patent. Obviously, registration charges and all are DAC. Can you capitalize that? Yes. So 2,50,000 you will capitalize. 7 lakh additional cost to successfully prosecute a copyright infringement suit against a competitor. Some competitor has filed a case against us. Obviously, case is going on in the court means we have to incur some lawyer and other fees. And fees they are saying is we have incurred 7 lakh. Can you capitalize this? No. This will go off to SPL. What about this 2,50,000? Yes, you can capitalize. That means you have to amortize how much? The life of the copyright is 10 years, they say. So 2,50,000. They have not given the copyright cost, so it's fine. All right. So where is that? Here. 2,50,000 is the registration cost, which will amortize over 10 years. So 2,50,000 divided by 10 will be amortization every year, 25. After amortization, its balance will be 325. So these are all your intangible asset. Total intangible asset is 69,45,000. That will come in your balance sheet. This is your balance sheet extract. You will show intangible asset at 69,45,000. What about that 7 lakh the case cost? That will be booked in other expense. So basically 20,000 you paid on your annual fees previously on your revenue, and the 7 lakh will be added. So 7,20,000 will come in your other expense. What about amortization? In P&L, there is a separate category called depreciation and amortization. If you add all this amortization, it is 16,25,000. That 16,25,000 will come in P&L as an amortization expenditure. That's all. Simple, you just have to prepare a balance sheet and P&L extract with 3 intangible assets ka amortization data. That's all was this question all about. Okay. Yes, that's all. Next, this is also probably one of the RTP question. An entity has an intangible asset in the form of product protected by patent, which is expected to have a net income cash flow of 15 years. They feel we have an intangible asset, it will last for 15 years. It has been recognized in the books in the initial date. Initial date means original cost at 12 lakh. So original cost of this asset is 12 lakh. Okay. The entity has a commitment from third party to purchase the patent in 5 years. Okay. Third party guarantee is there. Normally we assume residual value of intangible asset to be 0. But if you have any third party guarantee, can you take that third party guarantee as a residual value? Yes. How much is the third party guarantee for? In 5 years, you will get for 60% of the fair value of the patent at the date it was acquired. So what 60% of original cost is your residual value is what they say. 60 of this will be 7,20,000. So residual value is 7,20,000. Okay. So that means now 2 lives are being given. Entity feel it will last for 15 years, but this guarantee you have received at the end of 5th year. Now let's see. Because we know life means not total life, it is management intended useful life. How much management wants to use it for? That they'll give it. Check here somewhere. And the entity intends to sell the patent in 5 years. They want to sell off the patent in 5 years means indirectly they're saying they'll use this patent only for 5 years. It means you will amortize this patent not over 15 years but only over 5 years. So what will be your amortization? You bought it for 12 lakh, residual value is 7,20,000. You'll amortize it over 5 years. 12 minus 7.2 divided by 5, amortization charges every year is 96,000. Okay, you need to calculate annual amortization. That's all. That is your 96,000 per annum. Simple question. Okay. All right. So with this, in days 38 ka revision part also we have done. Thank you.